want to start with the intersection of the economy and markets because we talk about how important it is to get high-frequency data on the economic fallout from the crisis, and the weekly jobless claims really fits the bill. Yet investors seem to consistently look past it, focusing on brighter days ahead. Is this decoupling between the real economy and the stock market going to keep widening, or does it get reconciled at some point?
Well, Scarlet, first of all, let me say it's a pleasure to be with you, even remotely. And I think you've really put your finger on the key question of the month. And maybe no better day than today when we have such a rally going on, despite continued very poor news, I would say, in the real economy. The short answer to your question is that we actually believe the equity markets are substantially overvalued relative to what we think is going on in the real economy. In order to believe today's levels, you really need to believe we're going to have a sharp V-shaped recovery in earnings, starting really in the third and fourth quarters of this year and certainly for 2021. We don't think that's going to happen. We think there's going to be a much longer path to recovery, and that's really for three reasons. First, we think consumption is actually going to stay low for a lot longer. Yes, businesses are going to open up, but it doesn't mean that they're going to do business at the same level that they did. I often remind people that a great deal of consumer spending that happens in this country is done by people 50 and over. And they are likely to be much more conservative about jumping on an airplane and getting back to daily life. Secondly, we think that unemployment is likely to stay, quite worryingly high for a long time. And that's really because, well, first, some companies are not going to make it through this at all and won't be rehiring. Others are going to do their rehiring in phases, and many are going to find that they don't need to hire all the employees back that they had. So we actually think we will be stuck with a high unemployment rate for longer than people think. And the last reason, Scarlet, is that we have not even started to see the next big problem, which is the fact that our states and cities and municipalities are going to have a huge hit to their tax base and their revenues, and yet their expenses remain very high. And that is really the next crisis to come, which I think is going to, again, substantially affect economic recovery. So for all those reasons, I think we remain believers that this is going to be a slow road back and that the current markets are simply too rosy.
So, David, can you expand on that last point you made, particularly with the increased burdens that a lot of states, municipalities are going to have? Does this then translate, and even at the federal level to a certain extent as well, does this translate then into something where we need to start anticipating a potentially higher tax base? And if so, how does that then affect things like consumer spending and the sort?
No, I think it's a great point. I think that there's no question that we will be looking at higher tax rates, both federal and state. We can talk longer term about the deficit, but I think that's going to be part of the answer there. But my concern is actually more just over the next 18 months of getting a number of these groups through. As you know, many states can't declare bankruptcy. They must, in fact, keep a balanced budget. And that means they're going to have very substantial cuts to their services, which is the last thing that we can afford at the moment. Personally, I believe that I know it's a bit of a political third rail, but just from a practical economic point of view, I do believe that we're going to need a program from the federal government to actually help out states and particularly cities as we go through the next 18 months.
What will that look like, and what will each side have to give up to get that done? Because right now it feels like the Democrats and the Republicans are on complete opposite sides. Mitch McConnell even going so far as to suggest that certain states should perhaps even file for bankruptcy.
Yes, you're right. I think the politics of this are very difficult, and in fact may be ultimately not solvable. But I think that the economic consequences of not being able to find a middle ground are really very difficult to imagine. I mean, remember, so much of our education system, our hospital system, our emergency responders, our fire departments, that is all state and local government. And their revenues are going down and their expenses are not. And we'll need to find a way to inject some cash, at least for a period of time, into that to keep the whole thing running.
All right, David, I want to expand a little bit beyond the U.S. borders here, because when we talk about the performance of the U.S. market here and the expectations for economic recovery that seem to be being priced in here, I'm wondering how we reconcile this with some of the expectations for growth outside of the U.S., particularly in some of the emerging market nations, the expectation that some of those nations may lag the U.S. By a tremendous amount. There may be a wide gap there, and I'm wondering how we factor that all into growth prospects globally.
I think it's a really good point, and I think this is the crisis that is also yet to really unfold. Many emerging economies have taken on substantial debt over the last decade. Much of that debt is denominated in dollars. They've seen their currencies be pretty badly hit. Many of them are dependent on oil, which has obviously taken a real hit as well. And so we now find ourselves where more than 100 countries have actually approached the IMF looking for some kind of bailout or restructuring. And they're going to need it. In order to be able to do that, the IMF is going to need the support of the major developed countries, including the United States. They're going to have to expand their SDRs in order to be able to meet the needs of those countries. And I think we're going to have to step up to the leadership of that. Many of these were formed under the leadership of the U.S., and I think it's very important that right now that they be utilized to the max to try to make sure that these countries can deal with the real consequences to their economies, which hasn't really even been felt in much of the emerging markets yet. Our expectation is that we'll have a real bifurcation in the emerging markets, particularly for those that are dependent on oil, suffering a really difficult time, and others coming back a bit more quickly.
Yeah, you're talking about public debt. What about private debt? George Soros and Chris Canavan had written in Bloomberg Opinion earlier this spring about the need to consider a comprehensive debt standstill for at least 1 year from both the official creditors and private creditors, and they would both need to be on board with this idea. Is something like that even feasible in an era where far more flows come from bond markets rather than banks?
So at the moment, it would be very difficult to pull off. You're absolutely right to point out that over the last decade, actually the banking system has gotten less and less important in the flow of capital, particularly to developed economies. And the securities markets, particularly the bond market, has become much, much more important. But that doesn't mean that nothing can be done. So I think if the major countries, and they took some step forward, the G20, to do this for public debt, and I do think that it would be possible to get together some, at least, of the major bond-holding institutions and begin to talk about some level of forbearance for the debt. So I think Soros' comments was a good starting point. I think it would have to be modified. But we will need something like that to avoid a lot of pain.
David, we have to ask you about what we've been seeing in the rates markets, particularly today with the 2-year yield hitting a record low and Fed funds futures starting to price in the likelihood in investors' minds that we could see negative rates here, nominal rates here in the U.S. I just want to get your thoughts on that and what that could mean for markets.
Oh, it's a really interesting time to really kind of examine a lot of these issues, particularly with the bigger context in mind. I mean, we're now starting to see the kinds of new issuance that's going to be required by the Treasury to meet all of these new requirements. We also see the introduction, which we were very much in favor of the 20-year, and we saw really a steepening over the last week as people began to recognize this. At the same time, as you point out, people are also starting to contemplate the move to negative rates. And so the short-term implication of that has been a real steepening of the yield curve. We don't think that's going to last. We think that will gradually begin to flatten over time. But certainly for a while, we'll probably live with a steeper curve.